Good morning, good afternoon. Hope you guys are doing great today. We're Martin and Chelsea Matthews.
Yes, we are Martin and Chelsea Matthews, and welcome. Thank you so much for joining us today, where we're going to show you how to become your own bank. And we are married. We're in business together. We have a financial services and insurance agency. We're also authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And we're going to talk more about building an unbreakable financial house and what that actually means. But we didn't always have this financial knowledge that we're going to share with you today. In fact, 7 years, for 7 years, I keep having to remember each year, it's more and more years. So for 7 years before I met Martin, I was a single mom and I was struggling to find a balance between financial success and family success. And I felt like I was failing at all of it. And I knew I needed more information. And so I set out on a journey to find how money really works, how to make it work for me, and so that I could teach my son. And so I read books, I went to seminars, and I eventually met this group of financial advisors who were teaching people how money works, and they were making money doing it. And so I'm like, yes, this is what I need to do. This is right for me. And that's how I met Martin. And then, we realized that our goals were so much in alignment and the impact that we wanted to make. And so we combined our life, we combined our business. And now we get to teach people how to build an unbreakable financial house. So before we get started, I know we want to welcome you here, and we have some housekeeping information and all of that. So what do you want to cover before we get started?
Well, first of all, thanks for being on here. If you like this content, please share and invite other people to it. The information that we'll go over with you guys today is things that completely transform my life and that legacy, my generation, for generations. So financial literacy is extremely important. So we'll talk about that today. If you guys have any questions, comments throughout this, drop in the comments here. We have Rain, who works here in marketing with us. She'll be commenting on our page, and she'll be dropping things like that. So if you have questions or anything, we'll put it on the screen here also. So we'll shout you guys out like this. Paula says, doing great. Nadia says, good afternoon. Lionel, grateful for this platform. Thank you both for providing this information. Appreciate that. Thank you for that. Like we said, if you have any questions, please feel free to drop it in the comments. We love engagement. You can ask us anything, but we'll go through it. And this information I will go through, this should run about 30, 45 minutes to try to keep it concise. And we may leave some additional time to answer some of your questions towards the end as well. All right, so we're using a new platform today to share our stuff. So we're going to be sharing our screen. So if it takes us a minute or two to get our screen projected, some of the information we have for you, please bear with us.
And it'll be worth it.
Yeah. So here we go. Okay. All right. Okay, so let's make sure we can see it all okay on our end. All right, so I'm just checking on things, making sure it's sharing to you guys.
Yes, I can see it.
All right, so let's go.
Okay, great. So today we're going to talk about how to build an unbreakable financial house in your life and your business.
Yeah, so you just hit that one and she goes in right.
Okay. I'm learning this technology stuff. Okay. So this is something that's really important that we're going to help you to do, because we don't just tell you what to do and what to believe. We want to help you increase your knowledge, your responsibility, and your control. And we're going to talk about what that means. What do I push? Space? Okay. All right. So knowledge, responsibility, and control. The subject of finance is one that everybody can increase the level of knowledge about. Because with greater knowledge, you can take greater responsibility and be in control of your finances, not be the effect of it, right? We want to be in control of our life and our money, not it controlling us.
Absolutely.
So we mentioned a little bit earlier who we are. We're Martin and Chelsea Matthews. If you don't already know us, We're founders of M Wealth Group. We have clients in 46 states, and we have a combined 19 years experience. We lead an agency of associate advisors, and we hold multiple licenses in the field of investment advisory, securities, and insurance. So we're actually licensed to be giving this information to you. And we're also, as I mentioned, we're co-authors of the book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house.
And if you stay tuned till the end, we'll show you how to get a free copy of our book.
Yes.
How to get a free digital copy of our book. So make sure to stay tuned through the end of this.
So what do? We help individuals and businesses properly use cash flow to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by your design. Okay, so we're going to talk about what the heck is an unbreakable financial house. And this really means that you can handle anything that comes your way financially. And not just that, you can really create the life you truly want to live and make the impact you truly want to make. So we've discovered that there are 6 building blocks that make up your financial house. You either have a financial shack or a financial mansion or somewhere in between. We all have a financial house. And these 6 areas, these 6 building blocks, when you implement them properly, you can strengthen your financial house. And when you master them, you can have an unbreakable financial house. So I'm going to briefly tell you what those 6 building blocks are. And then Mr. Matthews is going to deep dive in our elite financial strategy to strengthen all of these areas.
Yeah, and part of when I get to my section, what I'm going to cover is, because I know a lot of you guys joined because we talked about how do you become your own bank. And so this is some foundation to build up to that. You got to understand, what are you trying to do overall? And then we talk about how do you essentially become the bank? How do you use wealth properly? How do you get your money working in more than one place at the same time? We're going to talk about all of that, but first we want to give people a foundational understanding for a few minutes, and then we'll dive into those pieces.
Okay, so building block number 1 in your financial house is cash flow. This makes the world go round, right? This is the money flowing in and out of your household and or your business. Okay, without cash flow, you can't really do much with the other building blocks. So it's very, very, very important to always focus on increasing that cash flow. Debt management is building block number 2. This is important to understand the difference between good and bad debt and how to use it to increase your wealth. Building block number 3 is reserves. We've seen how important reserves are in this pandemic we just went through, right? There were a lot of people who were making a lot of money, but living paycheck to paycheck or sale to sale. And when that money stopped, they were financially destitute. So this is very, very important. Building block number 4 is proper protection. Here we're talking about the right types and right amounts of insurance, health insurance, life insurance. Very, very key to have this building block. Building block number 5 is build wealth. We all want to build wealth, right? This is about understanding the enemies to your wealth that can destroy it, and about how to build, protect, and keep your wealth to be able to create the life you truly want to live. And then build legacy is building block number 6. And this is key to having the right documents in place so that all that you did to build a legacy, build wealth, build the life that you want to live to last generations, and really for everything that you set up to go accordingly, and so that your wealth can last for generations. You can truly make an impact beyond even your own life.
Yes. So you can keep talking. I'm going to switch this over to me really quick, and then we'll go back to some additional stuff we have to share with you guys.
Yeah, so when it comes to building your unbreakable financial house, we use these 6 areas to help our clients identify exactly where they are in each of these building blocks, and we help them identify what risks they could be facing that they may not even know. And also we help them streamline that process of getting where they want to be in the best way for their financial situation. And so at the end, we're going to show you how you can identify exactly where you are in each of these building blocks and how you can get exactly where you want to go.
Okay. I want to shout out these people. Hey guys, thanks for joining us. I want to shout out and recognize you. recognize you all for joining, for commenting. If you like our content, share it out with people. Vanessa, Donald, Shalina, Kiera, and I think I saw Shauna on here. So some of these people are clients of ours. So Shauna, Tony
Hey,
DaCosta,
Shauna.
Tony DaCosta was on here. Hey, Tony, hope you're doing great, buddy. And Pat, Donald, Natalie, thanks for joining. Thanks for watching. So I'll dive into some of my parts and how do we go from the things we need to learn and implement when it comes to our finances. So for one thing, I was born in Liberia in West Africa. I came to America. I didn't know much about money and finances. The only thing I knew is I thought everybody in America was rich and I needed to become rich too. So how did I do that? And then I didn't know where to start or what to do and where to go until I found people who would teach me information. And I realized that sometimes you have to unlearn some of the thing that you've been told. Sometimes you have to unlearn that information in order to relearn correct information. Because the way you actually find out if something is correct or true or not is, does it work? That's the true test. If you do it, does it work? You know, can you apply it? Can you use it? And so that's the test of any piece of information. So that's what we'll go through here, and I'll start talking about here with you guys and make sure I'm doing my screen share. Okay. All right, share. And it's going to get like a bunch of stuff on the screen, but then that's going to clear out as I go through this. And then if you see me look down on my phone, it's just because I'm checking to make sure everything's still showing right to you guys. Rain, can you check to make sure this other camera is recording as well? All right, so let's get rolling. So key financial strategies webinar, how the wealthy banks and corporations use elite financial strategies to build tax-free wealth without risk. So she just said recording on the bottom left. You don't have to touch anything. It should already just say recording. Does it still say recording? But does it say REC?
Mm-hmm.
Did you press that red button?
Yeah.
All right. So here's what you learn. First of all, you'll learn how to think a bit differently and how to avoid the pitfalls when it comes to money. And also you'll also understand the enemies of your money. You want me to check them? Yeah. Also understand some of the enemies of your money. Then 1 second, let me just move this Shauna's comment on the bottom so it doesn't fill up the screen here. 1 second, guys.
The screen's not even on. Is it supposed to be on?
Yeah, turn it on, turn it off, and turn it back on. All right. So let's go back here. Okay. So I'll show you also examples of who use these strategies and how they use them, how you can actually use them effectively. This is something we do in our personal lives. We use this with our clients. Some of these strategies we use in having our money working in one location and leverage it to have our money working in more than one location. So you'll have a good understanding about that when we're all done with this. So first of all, have you ever felt like there could be a better or smarter way to deal with your money? And also, have you ever wanted a simple and easy way to manage your finances or even put it on autopilot where things are simple? A lot of times people make finances and money very complicated, but when something's simple, it's closer to the truth. The truth is usually very simple. When somebody tries to make things very complex, sometimes there's confusion. So the clearer you are about finances and what to do, the stronger your finances will be, right? So for me to share some of this stuff with you, I want to go through a little bit of a history lesson and share what some of the wealthy people have done. So what did these two wealthy men do with their money? You have a guy named Cornelius Vanderbilt, who was a railroad magnate, and you had a guy named Mayer Rothschild, who was a banker. So how did these two guys who were wealthy, what happened generations later? Because a lot of people talk about generational wealth. So Vanderbilt, he died in 1877. With $105 million. He left $1 million to Central University. They renamed it Vanderbilt University. And so he left $104 million to his heirs, right? His next generation. So fast forward, they had a family reunion in 1973, 95 years later. 120 Vanderbilt descendants, they gathered for this reunion. There wasn't a single millionaire among them. So what happened? What happened to his wealth? So now we're going to talk about Rothschild. What did he do? When he died in 1812, he left a 3-part system for family wealth management in place. So it's not enough that you just leave money and resources. You also have to leave guidance on how this will be handled. That's why those 6 building blocks come into place. So the 3 things that he did was he said, number 1, the family's wealth was to be kept together in one family bank. So he came up with this concept of a family bank. And he said, number 2, the family could take a loan from the family bank, but the loan must be repaid. So, you know, a lot of times people want to invest in businesses and different things like that. They have to go to a traditional bank to get capital. But in this case, he's like, because he left all his money, they could go to a family bank. They could go there and get a loan from there to do businesses, to do all kinds of ventures they wanted to do. And then the 3rd thing was the family must meet once a year to share lessons learned. If not, they were out of the family bank. So as these people looked at, he wanted to make sure the wealth would last for generations, and that, you know, 1 or 2 people wouldn't screw it up. So they had these best practices, and they got together and they talked about what they did well and what they learned, and they shared tips and things. And that's how the wealth continued to stay in their family and expand. So when it comes to your money, it's not just what you earn, it's also what you keep. So the average American, the average person out there is going to bring in $1 million over their lifetime, right? $1 million over a lifetime is what the average American will bring in. So that's, if you make $50,000 a year and you save every penny of that money, you make $50,000 a year and you pay if you save every penny of that money and you are earning 5% per year, after 40 years, so let's say a person started working at 30, these are just general examples because I'm trying to give you some concepts for you to think with. Then I'll go into some numbers about how these types of strategies work, how you can build your own, what I mean by becoming your own bank, and how you can use your own bank to do all kinds of things. You can use your own bank to buy real estate, use your own bank to finance your cars, all these different things. But first, I want to give you an understanding of this concept and an understanding of generally about money, because people come at different financial levels and different financial understandings. You could be very sophisticated financially. You could be somebody who is just getting started, or you still just want to learn things about money. So somebody said the IRS and state authorities are the main enemies of our money. Yes, taxes are one of the biggest enemies of your wealth. So let's say somebody earns, and if you have any questions along the way, feel free to drop them in the comments, as I've said. A person earns $50,000 a year and they save all of it. If they earn 5%, they will earn, after 40 years, they would have earned $6 million. They would have $6 million in their account, right? So let's say if I start working at 30 and I was saving $50,000 a year and I was earning 5%, I'll have $6 million when I'm age 70. Now, of course, you have to live. So if you make $50,000 a year, you couldn't save it all. But I want you to just think with this concept, and as we go through, you'll understand why I'm starting it off this way. So this is what it looks like graphically. See that graph? I'll start by putting the $50,000 a year away. Boom. After 40 years, I've got $6 million. So I have to pay my taxes, right? So if I make $50,000 a year, I got to pay my taxes. Let's say I pay 28% taxes. That leaves me with $36,000 a year. And let's say I saved the entire $36,000 a year. Look at the impact of taxes on my wealth. If I didn't have to pay taxes on that money, up here I would have had over $6 million. But because I had to pay the taxes, and I have to, even if I save all of it after I pay the taxes, I end up with $2 million less. Because I have less money working for me because I have taxes. So your largest bill, whenever I ask people, what's the biggest bill you have? They will tell me their mortgage. Usually they'll say their mortgage. They'll say a few different things. Their kids. Kids are a big expense. So, but very rarely do they say, you know what? My largest bill are my taxes. And so when you look at it, a large percentage of income. Why? Because if you work for somebody else, and if you're a W-2 employee, to take the taxes out before it sends you your money. Because the government has it set up that way because the government doesn't want you to not pay them. So they take the money out. So a lot of times people don't calculate that entire tax amount and look at that as a bill. But that is a bill that you have to pay. And it's the largest expense that people have is taxes. Now, of course, so let's say this person makes $50,000 a year. They pay their taxes. they take home $36,000. Here's how most people do it. So out of that $36,000, they would spend about 90% of that money on their lifestyle. So 90% of that money will go towards their living expenses, their rent, their car, all their credit cards, all these different things. And then they may save maybe 10% of that money. So they will save about $3,600 a year. That still represents this green part. But look at how much their lifestyle and taxes cost them, a massive amount. This is why when people get to retirement, they have very little money, even though they may have accumulated, they may have earned over $1 million in their lifetime. They get to retirement with too little, right? Because you have to live. You can't live on rice and beans, ladies and gentlemen. I don't care what anybody tells you. Nobody wants to live on rice and beans. You live in America. Why would anybody want to live on rice and beans if you don't have to? So how do I do the things I want to do, still have a lifestyle, still drive? I don't have to drive a beat up car if I don't want to, and still build my wealth at the same time. A lot of times people tell you you can't do both. But what I want to do is encourage you to think, how can I do both? Not I have to sacrifice my lifestyle, or I can't build wealth because I have to pay debt. All of those things you have to look at. How can I do both? And that's where a lot of times we come in. Our focus is, how can I do both? How can I still take a trip with my family and still handle my debts? How can I still build wealth and enjoy some other things today? How can I do both of those things? Not one or the other, even if the person doesn't have an astronomically high income. So in order to do that effectively, it comes down to how you view and how you use money. So there's a couple of different ways. These are kind of just generic ways of things I've observed, but there's a couple of different ways on how a person views and uses money. One, you can use money as a spender. You can view money, hey, I get this money, I just spend it. If spender's not thinking about saving money or building wealth, hey, I'll spend it. And then you can view money as what I call an investor. Or you can view money as a banker. Now, sometimes people go through gradient steps, and sometimes you look at, hey, sometimes I'm viewing this as an investor, and sometimes I'm looking at this as a banker. And I'll explain to you these different ways. So the spender views money as a way to buy stuff. Okay, I get money, I'm going to go buy it. I'm going to go out and I'm going to use this money because you only live once and blah, blah, blah. So that's the excuse of the spender. I'm going to enjoy it now. Every purchase costs him interest. Every purchase costs him interest, person who likes to spend. So if you borrow money, you pay interest whenever you borrow money because you want to buy stuff. Like there's a lot of people I know who buy a bunch of cars. They buy a car every day, always changing their cars all the time because they like that. That's their game. And so a lot of times they may be borrowing the money to buy the car. They pay interest to borrow that. Now some other people say, no, you know what? I pay cash for all my stuff. Well, the flip side is whenever the cash buyer pays cash, he is giving up the interest that money would have earned. Again, we always talk about, how do I do both? How do I keep my money working and buy the car at the same time? So as we build up, you'll understand how to do that towards the end here. So let's talk about buying a car. I'm just going to check to see if there's any. If you guys have any questions, like I said, feel free to comment on here. Just be monitoring too if there's any questions. There are 3 ways to buy a car. One, I could borrow the cash. I could borrow money to buy the car. My very first car I bought in America, I paid cash for it because I'm like, I didn't even understand credit and borrowing money. I didn't even understand that. So I'm like, okay, I'm just going to save the money. I'm going to pay cash. So I paid cash for the car. A year or 2 after having a car, I got into a car accident. This guy runs the red light, and I hit his car. He was drunk, runs the red light, I hit his car, and boom, my car gets totaled. Well, luckily for me, or unluckily for me in this situation, the guy did not have any car insurance. So my car gets totaled, he doesn't have car insurance, and I need a car. So I didn't have the cash now to go buy a new car, so I had to go and finance it. It's the first time I financed a car. So I go in and borrow the money and to go and pay for this car, right? Or the third way a person could use to buy a car, something called a private family bank. Remember, Rothschild, we're talking about how they established a bank. So I'm going to show you how to do that. First of all, let's explore what the difference of borrowing money for borrowing cash or paying cash for the car. So let's say over your lifetime, you're going to buy 11 cars. And let's say every 5 years, you're going to purchase a car. So you buy 11 cars over your lifetime. Now, if my average car costs $30,000, let's say, these are just basic numbers, just using it for math to keep the math simple. So $30,000, right? And then I paid 0% interest rate. Seeing 11 cars every 5 years, I'm buying a car. So you see the borrower who borrowed money because there was no interest paid $330,000. The cash buyer also paid $330,000. That's $30,000 per car, 11 cars, right? Now, let's factor in some interest. Let's say, because that's why the person pays cash. Like, well, if I pay cash, I save on the interest. Well, let's look at that. So the borrower, the guy who borrowed money to buy his cars, if he's paying 5.5% interest rate every time he does that process, well, he would have spent $378,000. The cash buyer spent $330,000. So yes, obviously the guy who's not paying interest will spend less money than the guy who is paying interest. But what's the question nobody asks? How much money is the guy who's financing it makes? So the bank over a period of time, over that lengthy period of time, will make $380,000 off of financing cars. So clearly the bank's putting up capital and people are using their capital because we may not have money to pay cash for things. So whenever I want to buy something and I am borrowing to buy, here's what happens. I go into debt. So I go, boom, I borrow the money, go into debt. I borrowed $30,000 to buy a car. I spend the next 5 years paying it off. And I get back to zero. Then I go and buy another car again. I go into debt. Then I go and pay it off. I go into debt. I go and pay it off. That's the cycle. That's the cycle a lot of people are in America. They go into debt, and then they try to pay it off. They go into debt. They try to pay it off, right? But they end up back at zero, which means they owe nothing. Now, in order for me to pay cash, what do I have to do first? I've got to save the money. So I got to save this money. If I want to spend $30,000 or whatever is a car or whatever it is, I'm just using car as the example here. But I build this, I got to save this 30 grand. So I save this 30 grand and I spend it. I go back to zero. I build it up again. I buy a car. I go back to zero. I build it up again. I buy a car. I go back to zero. Have you noticed that the guy who's paying cash and the guy who's financing, they all end up back at zero? I pay it off. I now owe nothing. I'm back at zero. I had all this money saved up. I spent it on the car. I'm back at zero. Now, what if there was a third way? What if I decided to build up my capital, but instead of spending it, I allowed it to keep building and I leverage it to buy my cars? Remember, we talked about how if your money compounds over a long period of time, how much it goes up. So you see, it starts to build up here. And what if every time I wanted to buy a car, instead of just taking the money out because it's earning me interest, I could leverage it to buy my cars and keep my money continually working for me without interruptions? That would be an ideal situation. That would be the ideal way to do it. So we talk about how an investor might view money. We talk about how the spender views money, whether you're buying, whether you're paying cash or you're financing. When you need to buy things, you got to pay for it somehow. So you're either going to pay cash or you're going to finance it. So an investor views money as a way to buy investments. So investor, he would trade his money for an investment and hope that it goes up in value. So every investment, depending on what type of investment it is, exposes to some risk. And depending on your gains, cost and taxes. So for example, in your retirement account, for those of you who have retirement accounts, every time a retirement account goes up, guess what's happening in there that you're not factoring? Yes, your money's gone up, but something else is happening. The share of taxes, the share to Uncle Sam has also gone up. Because if I have $100,000 and that grows into $1 million, and I go to try to take my money out of a retirement account, guess what? I have to pay taxes on that $1 million. So Uncle Sam didn't help me grow that money, but they take a piece of it. So you have a partner inside of your retirement account. I won't spend too much time on that, but I will talk about understanding risk and why it may make sense to grow your money without taking on a lot of risk, where you can still compound and grow your money without losses. So imagine you have $100,000 that you invest and your investment goes up by 10% in the first year. And in the second year, it goes down by 10%. Are you back to where you started? Do you have the 100,000? You went up 10% and went down 10%. The answer is no. You're down $99,000. So you're still behind where you started with. You actually lost money. So this is something that people don't fully factor in when they're looking at investments. The more you lose, the more you have to gain just to get your money back. That's why we don't like to lose money. That's why Warren Buffett said, don't lose money. So if I have a 10% loss, I need 11% just to get my money back. If I suffer 20%, I have to get 25% just to get my money back. See, so when you factor in the impact of losses, it impacts your wealth. So if I lose 40%, I need 67% gain just to get my money back. Well, if you have your money in an investment account and you lose 40% of that money, how do you feel about that situation? A lot of times people feel like they become risk averse. They're like, damn, I had $1 million, I lost 400,000. Now I got 600,000. That's a big impact. So now they're scared. So losses tend to make people scared over time because it hurts when people lose money. So one of the things we try to look at is how do you grow your wealth without losses? Now what time is it now?
It is 12:34.
Okay. All right. So we'll get to some examples on the banking here in just a quick second. So how does a banker view money? Views money as a way to make money. Every purchase is an opportunity to gain. How do I gain when I'm purchasing stuff? And I always want to keep my money working. See, if I pay cash for everything, my money stops working. If my money is compounding and I pull it out to pay cash, I interrupt the compounding. I want my money to keep working for me. So there's something called compound interest, which is the most powerful force in the universe, according to Albert Einstein. And this is something we call a wealth curve. So the wealth curve allows you to be your own bank. So what does that mean? If I have my money in an account earning me interest, I want it to compound and stay that way forever. But I also need to buy things. I need to buy cars. I need to buy property. I need to do lots of different things. So how do I keep my money working for me and buy cars and buy property and do all of that at the same time? Well, it comes down to the vehicles that you use. So what if we could use your money without giving up the interest it would earn? So the way that would work is, first, I needed to create a pool of money. I need to put my money somewhere where it's earning compound interest. And I need to be able to use the pool of money as collateral for when I need cash, right? So I got the pool of money. Does that all make sense? Just let me know if that makes sense. If you guys are following in the comments, let me know. So the idea is I want to put my money in an account that's growing. It's earning me interest. And then when I want to buy stuff, I want to be able to take a loan against it, not take the money out. Because if I take a loan against it, I can still have my money working for me and buy the car or buy the real estate property at the same time. That's what I want to do. I want to do both. I want to be able to have my money working for me and buy real estate at the same time. Well, if I can leverage that money to buy income producing assets like real estate, that real estate will cash flow and pay me interest every month, right?
People are tracking. They say, yes, makes sense.
Okay, great. So here's another question. I'll show you some other examples. If your money was earning 4%, would it make sense for you to borrow money at 6%? I want you to think about this one for a second. If so, I'm earning 4%, would it make sense for me to borrow money at 6%? The immediate answer when you ask people this question, they'll go, no, because the interest is higher. They will say, no, it doesn't make any sense for me to borrow against that. But I want you to consider the numbers because most of the time people don't think about it that way. Because you're always told debt's bad. It's bad for you to borrow, all these different things. That's what you're told. And what I'm trying to do here is give you some truth and some insight behind how things actually work. So that when you understand that, you can make better decisions for yourself, right? And how to use money to actually accelerate your wealth. Now, here's the proof of that. So let's say I go to buy a car and the interest rate is 6%. And let's say I got to pay this car off in 60 months, which is 5 years. My payments will be $580. So the total I would spend for that car is $3,400 $34,799, right? So almost $34,800 is how much I would spend to own that car if I'm financing it. But what if I had my money set aside and I was earning 4%? After the same 60 months, after the same 5 years, I have $36,630, even though the interest rate was lower. So in that case, it actually would have made more financial sense to not pay cash for my car, to actually borrow, because my money would be higher than the interest I would have paid for the car. You understand? What if this was flipped? So I'll say that again. In this situation, if I had the $30,000 in an account earning 4%, and I went somewhere and it said, hey, we can finance this car for 6%. A lot of times people say, no, I've got the money, I should pay cash. So to do that, I'm not saying it's wrong either way. I'm just saying this is what the number is. You get to decide for yourself which path you want to do. So the way a banker would look at it and say, okay, well, what's the math? So the banker will say, well, if I'm earning 4%, and my account at the end is going to be $36,600, it would make sense for me to finance or take a loan against my money. What if I established my own account, built my own bank, and I could borrow against myself, and then I could pay myself this $580? Aren't I giving myself the interest that I would have gave a traditional bank? And my money is still growing. So think about that. So instead of financing it from a party I didn't know, let's say a bank, what if I built up my own capital and I was able to borrow against my capital while it was growing? And I took this $30,000 against myself and I went and bought this car and I made the payments back to myself. Remember what Rothschild said? You could take a loan against a family bank, you had to pay it back. So as you paid it back, guess what? My money's still been growing at the same time. And this $580, instead of it going to a traditional bank, it was going to the bank of myself because I took a loan against my money. Now, let's take it out a step further. What if this was $100,000? And I took that $100,000 and I put it into real estate, which is what we advise a lot of people to do, is they can establish their own accounts, build it up, leverage it, and put it into an income producing asset. Now, instead of me paying on that car, I've got the real estate that's paying me every month. So right now, Chelsea not shopping for assisted living properties because assisted living properties have very strong cash flow. So I'm looking at the cash flow from the properties. You understand? So you establish your own bank and then you do that. So how does one go about and establish their own bank?
Well, perfect timing, because Kira asked, can you explain that even further? I don't understand how you're borrowing the money against yourself.
Okay.
Perfect question at the perfect time.
So I'll skip some of these. So what's the financial instrument we use? Now, when I say establishing your own bank, I'm not talking about you going and registering a bank and putting the capital up for do that. The average person does not have the ability to do that. However, we use something that's been used for hundreds of years that even banks use. So the same financial instruments that banks use to park and grow their money is a vehicle called life insurance. You can have a properly designed life insurance policy that you can use in this fashion. So let me explain how that works. First of all, banks actually use it. So when I started looking at what do banks do? Where do banks keep their money? Do they keep their money in the bank? No. One way they make money is to lend money to you and I. So if we're going to put $10,000 in a bank account, the bank can turn around and loan $30,000 out to people because the bank doesn't need to have all the money in reserves in order to make loan. They only need to have a fraction of that money. So the bank can lend. I can go and put $10,000 in the bank, and I turn around. If I want to borrow $10,000 from the bank the next day, they will probably charge me way more interest than they're paying me. So let's say I put $10,000 in my bank account, and they pay me 1%, and I go back the next day, and I say, hey, I want to borrow $10,000. Well, they could charge me 3%, 5%, 10%, 20% if I trying to borrow that $10,000 on a credit card. So the bank makes money by leveraging our money. So,
excuse me.
Bless you.
Thanks.
here's something I'm going to show you here. So you guys still see my screen, okay? This one says FDIC. So this is on FDIC's website. Anybody can go and look it up and see that banks actually use life insurance as a place to store their capital. It may be too small on the screen. You guys may not be able to see it, but
I think they can see it.
this is Bank of America. So you can go to FDIC website. You can look up what assets all these where do all these banks have their money? So, all right, so let me restart it because I was on here earlier. Okay. Okay. Give me 1 second. All right, so we're going to search Bank of America. You can search any one of these banks and it will tell you where their assets are. So we're going to look at Bank of America, and you'll see how Bank of America actually uses life insurance policies, properly designed permanent life insurance policies, to store money. And these types of policies allow you to have your money working, and you can take loans against it. They effectively act as your own bank. So we use life insurance for its banking function. We use life to bank through life insurance. We store money inside of a life insurance policy, we design it properly, and then we leverage it to buy income producing assets. So that's how you borrow against that policy, and you put it in different locations. Usually we're using it for real estate. We're using it for all kinds of different things to expand businesses, stuff like that. So we say, okay, we want to look at Bank of America and what is Bank of America's assets, the assets and liabilities. So these numbers over here, you add 3 zeros to that because this is shown in the middle. They don't want to make the numbers too long on a page. So if we go down here for Bank of America's assets, it says life insurance assets. So life insurance, remember we add 3 zeros on the end on here for this form. So it shows here that Bank of America has almost $23 billion stored inside of life insurance policies. Now, why would a bank store money in a life insurance policy? Well, because one, they're allowed to, something called bank-owned life insurance. So why would a bank own a life insurance policy? They store capital inside of the policy because they can earn a guaranteed interest rate higher than what they have to pay you, and they can also use it. They can use that money for many different things. Now, Bank of America actually has more cash inside of life insurance policies than they have for what's called other real estate owned, because you know that Bank of America has their own real estate that they own, and then other real estate owned have $371 million. So they actually have more money sitting in cash inside of life insurance policies than they have sitting in other what's called other real estate owned, right? So let me go back to my main page here. All right. Okay. So there's life insurance policies that we use that allows you to store capital, just like you can send money to a bank account, you can send money to Wall Street, you can send money into a life insurance policy. So we customize and build our life insurance policies to use for its banking function. So you understand why it makes sense that people may leverage their policy to buy an income producing asset, because I have my money working in one location and leverage it and have it working in the second location, right? So we've been doing this for years. One of our clients recently leveraged his policy to buy property in an opportunity zone. And so opportunity zones are areas that need capital. So the government gives you tax advantages for putting capital into opportunity zones. So we use it primarily for income producing assets. So it has liquidity, which means I got access to the money whenever I want. Now, a life insurance company, the types of life insurance that we use, we have a part of our business is an insurance agency. So we own, we can do business with many, many different insurance companies, right? So part of that is we leverage the administrative capabilities of insurance companies, because when you own a policy with some of these companies, you are actually an owner you're a part owner of the company. So you own a life insurance policy is a contract, and somebody owns the policy. So when you're the owner of the policy, you actually are a part owner in some of these companies. And so some of these companies pay you some of these policies pay you a fixed interest rate that's greater than what you earn at the bank. And based on how well the company performs and the company does well, they actually pay dividends on top of that. And they pay dividends to you because you're a part owner of the company. So the insurance company is an administrator of all of us who own insurance policies within that company. Does that make sense? So it's something that we leverage and use for guaranteed growth. So we don't want to lose money, so we want to get guaranteed growth. We can access the money on a tax-free basis. So you can access money inside policies on a tax-free basis. Protection from judgments. So you have protection in life insurance policies from lawsuits versus say different types of investment accounts. And I say this in the beginning is Chelsea and I have held securities and investment advisory licenses. We've had a Series 6, Series 63, and Series 65 licenses. But I'm just explaining to you this as a concept because it's something that we use for a lot of clients, right? So we put money inside of a life insurance policy. We use it to buy income producing assets, whether it's real estate or businesses and things like that. You can use it to finance cars and everything. All the while your money stays in a policy and continues to earn interest. So I'm going to show you this concept, and I'll show you some numbers behind it. So a few years ago, there's a guy who coached Michigan. His name is Jim Harbaugh. He went to the Super Bowl a few years before that. So a few years ago, in 2016, he renegotiated his contract with the University of Michigan. And he says, instead of giving me a higher salary, give me a loan so I can buy life insurance. To the average person out there, this would seem like a very odd thing to do. Why would anybody ask for an increase in their pay as a loan and to buy life insurance? So it says, in addition to paying a $5 million salary for each of the remaining 6 years on his contract, Michigan will also loan Harbaugh $4 million in 2016, an additional $2 million for the following 5 years to pay the premium on a life insurance policy. Yeah. So this is whenever you see stuff like this was on ESPN's website. And I bet a bunch of people read this and just never thought anything about it. Like, why would a guy take his compensation as a loan? That's the question people have to ask. Why would somebody take the compensation as a loan? Number one, because loaners are not taxed. So when Jim Harbaugh got a $4 million loan from Michigan, there's no taxes on that. When he got $2 million every year, there's no taxes on that. His salary is taxed and he's taxed at a very high tax rate because he's a high income earner. So how do I shelter some of my money from taxes? He took a loan. So as long as the policy stays active, Harbaugh does not need to repay the loan until he dies. So there's ways you can even take life insurance policy loans that you don't have to pay back until upon your death, and your death benefit will actually pay off the loan for you. So someone says, so she said, look forward to reviewing the video. I'm just trying to read some of the comments and make sure I see if there's any questions. Getting insurance policies, adding money to the insurance policy every month. Once you want to borrow from yourself, you just borrow from the money. Yes, you borrow against the policy over time, insurance policy payback. So you're paying yourself back and your money's still compounding at the same time. So your money can keep growing without you having to, your money can keep growing even while you take a loan against it. You simply use it as the collateral. That way, just like the guy we talked about who pays cash, but when you pay cash, your capital that's working for you is no longer earning interest for you anymore. You took the $30,000 and you bought a car with it. So that $30,000 is no longer earning interest. But if my money's growing and I take a loan against it and I buy the car, and if I pay myself back, instead of paying the interest to a finance company, I'm paying it back to my own policy. Plus, at the same time, my policy is still compounding because the money's never left my account. So, and this is common. This is common in the corporate world. So we do this for a lot of executives. It's called executive. We do it through executive bonuses, executive compensation. But the average person can do this. You can look at building up your capital and then leveraging it to buy the different things you want to buy using your own bank. So that way you instead of paying interest to the bank every time you purchase something. You pay that back into your own policy, plus your policy continues to compound while that's occurring. Now, last thing I want to share with you here before we end is, okay, where's mine? I was going to show you some of the numbers behind it. So hold on, I'm going to stop the screen share really quick. And then Chelsea, check to see if there's any questions. And I'm going to show you some numbers behind it before we wrap up, so you guys can see actual numbers, and then we'll show you how you can actually get some numbers for yourself. So while I do that, why don't you tell them where they can get, if you want a free strategy call with us, or they want to see some of the numbers for themselves, where they can actually get.
Yeah, so if you guys would like to see how you can become your own bank and look at strengthening your own financial house, our offer to you is a free strategy call to go through the 6 building blocks and really look at your specific numbers for becoming your own bank. And you can request that call at 6buildingblocks.com/strategy. Again, that is 6buildingblocks.com/strategy, and Rain will put that in the comments. You guys can request a free strategy call. We'll be happy to go through your personalized numbers so you can see what it would look like and how to create your own bank. I think you answered the question about borrowing from the policy. And then someone was asking about the link for the book. We'll send out a link to everyone who registered after to get a copy of that. And we'll probably put a link in this stream as well at the end.
Yeah, and then I see some other questions on here. I'm going to answer those just in a quick second. Let me do this because I don't want to keep you guys too much longer from where we want to do this. So let me share this part with you so you can actually see some numbers behind some of this. Right. So people are asking what types of life insurance. They're permanent life insurance. There's different types of permanent life insurance that we can use for this. But what we try to do is we look at each person's situation. We find the right vehicle for that person. So I'm gonna do this, and I'm gonna answer some quick questions before we wrap up here. So this is somebody who's putting, these are just arbitrary numbers, which means I'm putting these numbers just as examples so you can see. So this is somebody who's putting in $1,000 a month away, and they're building a capital using that. I'm going to put $1,000 a month away, and I want to use it. You can use that. You can use this money inside your policy for reserves. You can use this to pay off debts as you build up your capital. You can use it for many, many different things, right? So now in here, we'll look at this where it says current illustrated values. So if we're earning, we don't have to earn astronomical returns. But let's say we're earning a little over 5% on average, which is greater than what you earn sitting at the bank. So one, I can earn a higher interest rate than a bank. I can get life insurance, which would pay my family from day one. If anything happens to me, I get a life insurance policy. But we're using this policy more designed for its banking function, not necessarily because of the amount of life insurance we want to have on it. So we design a policy in a way to maximize the cash side of it, not necessarily trying to maximize the life insurance side. So if we do this, let's say somebody funded $1,000 a month, and it did this starting at age 35, and it did this till age 70. At age 70, the policy would have accumulated $1.3 million of cash in the policy. Okay, so let's say I wanted to use it before age 70 because I want to be using my money along the way as my own bank. How do I use that? So some policies you can use within the first year. Sometimes it's after year one. But in the first year, after the first year in this scenario, I've put $12,000 in there. I could turn around and take a loan of close to $11,000 against my policy. They give me a loan against the policy. Now, here's the thing about life insurance loans. With the life insurance loans, there's no credit checks. So it doesn't show up on my credit report. So if I took a loan against my policy and I paid down my debts that do show up on my credit report, it will actually help to improve my credit score because it will bring down my credit utilization on those types of debt. So let's say I have money in my life insurance policy, but I also have credit card debt. I can leverage my life insurance policy, pay down a credit card debt while my money still continues to compound inside of the policy, which will actually help to improve my credit score because it will reduce my credit utilization rate, how much credit I'm using. So you can use that to pay down those types of debt. But let's say I want to use it to buy an asset. I can go and take a loan. So let's say year 10, I've got almost $140,000 built up inside of the policy. And let's say I want to do a real estate deal. I can go and take a loan against my policy, take a $100,000 loan against my policy, and I will still be earning interest off of this $139,000. So even though I received $100,000, I take that $100,000, I put it into a real estate deal. I use that real estate deal will pay me cash flow, and my money will continue to compound in the policy. And then when I die, my policy still has a death benefit that will pay tax-free to my family, and we still own the real estate. And the real estate will continue to pay cash flow. So I get a loan against my policy, which doesn't involve any taxes, and the loan is guaranteed, which means I can go get a loan whenever I want. It's not based on my income. It's not based on if I have a job or not. It's simply based on, do I have capital inside of my bank? My policy that I'm leveraging as my bank, right? So these policies have to be properly designed, and they have to be designed by somebody who knows what they're doing and how to structure these policies, right? So,
Okay, so we have a question, and then we can wrap up.
Okay.
Veronica asks, I'm a single woman, no kids, and want to buy a home within the next 12 to 18 months. Would it make sense to buy all of this insurance with no heirs? Help!
It depends. And this is where when we talk to people on a one-on-one basis, we help them identify if this is the right strategy or if it's the right time for them. So it depends on how much capital you have built up, Veronica. There are some reasons why you may want some life insurance, even if it's not this type. You may want to have even a term life insurance policy that has living benefits, even if you're a single person with no heirs. And now a reason for that is some of the, if you're a single person, it means your livelihood is dependent upon your income. If you got sick or hurt, now your income could be impacted. Whereas some life insurance policies that can pay you while you're still living, if you got critically or chronically sick. So you may want to use a policy like that as well. But we may want to talk to you a little bit more first and then find out if this is an appropriate strategy for you or not. If it's not appropriate, then you may want to just use a term life insurance policy until you buy a house, and then we can use that. So it depends on how much you have saved up for the house, how much you want to, when you're trying to buy the house, things like that. But we always look at things from the point of view of what's the best thing for our clients and advise them on that. If this is not the best thing for them to do at this stage, we'll tell them, let's do something different and then build up towards that. So we always take that to where we guide our clients. But you can go to 6buildingblocks.com/strategy. We'll do a strategy call with you where we go over cash flow, debt management, reserves, all of that. And that will let us know where you are in terms of finances. And all of you can go to that link and request that. And then we will be able to, advise you on what's the best thing for you to be able to do for that.
And we'll be posting a link so that you can get a free digital copy of our book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And
so actually, before the link is actually, you go to letsfightaboutmoney.com/ebook. So the ebook is a digital copy of it. So Ring, why don't you just comment that in there /ebook. And that's where you can go to get a digital copy of the book.
And to request your free strategy call, you can go to 6buildingblocks.com/strategy. And we thank you so much for joining us. We really want to share the knowledge that we've been able to learn to strengthen our own financial house and the clients that we work with. And we want to help you build an unbreakable financial house using these elite strategies like we talked about today, how to become your own bank. So we hope that you got value and you enjoyed this event. And we look forward to talking to you further and helping you strengthen your financial house so you can truly create the life that you want to live and make the impact in your family, your business, your community, and beyond.
All right. Thanks, guys. Thanks for watching. We'll catch you guys next time.